All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market's been open here for about 45 minutes. We have about 15 minutes to go before I get the signals that could possibly come in. They're really just looking at it, and this could change, but just looking at it now, two possible ones. Facebook, which is still short of a bullish signal here, and Honeywell, which is still short of a bullish signal, but both of these in the next 15 minutes could emerge as a signal here. So we'll kind of see where those where those end up here in about 15 minutes. IBM potential, but very very unlikely there. So some of the ones that have a little bit of potential, the probability of it happening in the next 15 minutes, very slim. By the close, a little bit larger. And then J&J, there's really no change on the stock price here this morning. It's been up 10 cents, it's been down 40 cents, just kind of J&J like here. So well within the parameters for the trade. So chances of me making a change here this morning are pretty slim, but in about 15 minutes we'll revisit that and see where things are. But did want to hop on here and talk about Lowe's and Chevron. These are two stocks that I've been asked about to go take a closer look at, and so let's go out and do that. Let's start here with Lowe's. And Lowe's here, retailer here in the U.S., lumber, and we saw Home Depot earnings. The night before? We saw Lowe's earnings last night, and Home Depot gapped down on their earnings and rallied. Here, this is an interesting earnings report, an interesting reaction, but it's even more interesting when we compare it to Lowe's reaction, and this just absolute getting crushed that we see here from Lowe's. Let's just kind of go look at what the data looks like here for it. And if we just come into Estimize, I'll put in Home Depot first. And we can see Home Depot, they beat on their earnings, right? They beat on their earnings. And on a revenue standpoint, pretty much in line. But take a look at the revenue trend here for Home Depot. Year-over-year growth, 6%, 8%, 8%, 4%, 8%, 5%, 11%, 6%. Next quarter projected is 2%, right? And as you start to look out, the quarter-over-quarter, year-over-year growth rates are starting to get a lot lower. Right, they're not looking nearly as good as what they have. It suggests some of the best is behind. When you look at the earnings, it looks the same: 14%, 15%, 17%, 25%, 36% year-over-year growth rate in earnings. I mean, this has been a phenomenal growth rate. 33%, boom, 9% growth rate. So while some companies out there would kill for a 9% growth rate, 9% is significantly lower than what it has been. And then going forward, you see the projections. They're significantly lower. And this is one of the fears of Home Depot, one of the worries that Home Depot investors have. It's been a great story, but that story is showing signs of reversing and showing signs where, look, the comparables, to be able to do what they did over the last 2 years, that's going to be tough to live up to. We saw Starbucks go through this, right? Where, they were fantastic for a long period of time. Right, they were just a great company. Sorry, let me go back further in time here than what this is giving us. But Starbucks was just a great stock, great company, doing everything right, phenomenal growth, and the stock 2010, 2011, 2012, 13, 14, up and away, and then here's 16, 17, 18. What happened? Right? It wasn't that, Starbucks was a terrible company, but keeping up with the comparables was very difficult, right? The numbers had been so good, the growth rate so good, that keeping up with that just wasn't feasible, and we saw what happened. The growth rates, they were pretty stagnant. The comparables were tough to live up to. And then, we talked about last year that was finally changing. Where with Starbucks, now they're not living up to they're not having to live up to some of these comparables from 2011 to 2014. They're now having to live up with live up to a lot lower comparables from 2017 and 2018, and it just makes the growth rates look much more attractive. Starbucks is in that bullish mode with the growth rates looking more attractive. Home Depot's pushing into what Starbucks was back here in 2015, where, man, living up is going to be very difficult. Now, we go to Lowe's. Lowe's has always kind of been, kind of second best to Home Depot in many regards. You take a look at Lowe's from an earnings standpoint, year-over-year growth, 20%, 19%, minus 14%, 60%, 32%, minus 1%, right? A lot more volatile. But look at these projections going forward. They're pretty massive. They're pretty massive. That's on earnings. Here's on revenue, right? So they're projecting huge earnings growth increases, but not with much revenue growth increase. Okay. That's going to be tough to achieve, but achievable with the right accounting, but going to be very difficult to achieve. So why is Lowe's down so much? Well, let's come into Y charts where we can chart some of these fundamentals. We already know the comparables for Home Depot are going to be difficult. By comparison, the comparables for Lowe's, they're going to be difficult, even though they're not as great there. But when we come into Lowe's and just bring up a fundamental chart, there's just something that stands out in Lowe's earnings. I'm going to come down to margin. Now, what is margin? Margin is how much money you make per dollar spent, right? So, if you're running a 50% margin, every dollar you spend, you make 50% on that, or 50 cents on that. Right, and generally for retail companies, margins are pretty low. But take a look at this margin collapse here with Lowe's. I mean, that's going to impact earnings. It's one of those things where, you can grow revenue, but your earnings are actually going to shrink with that type of margin. Now, there are all different types of ways to look at margin, profit margin, operating margin. Any way we slice it, any way we dice it, the margin's cratered here. And that's a big concern. And that's why Lowe's is down. We can find other holes and flaws in the earnings, just like with Home Depot. We could talk about tough comparables and everything else. But who are you going to own, Home Depot or Lowe's? I mean, we don't see Home Depot margins cratering the way Lowe's margins are. Here's Home Depot's margins. They continue to grow the margin. They continue to increase margins. Their margins are better than Lowe's. Both operating and profit margin, they have been able to, really do well there. And their absolute numbers are better. Their trends are better. And Lowe's, that's just a big hole, a big flaw. Now, Lowe's had some activist investor activity last year, and some activist investors getting heavily involved in the stock and in the company. I would not be surprised if those investors are leaving. And that's where a lot of the selling is coming from here today. After seeing, that basically saying, look, can we really turn this around? It's going to be tough sledding. I would not be surprised to hear some positive commentary from some of those activist investors here soon, just to try to bump up the stock so they can sell it. That's a common ploy that we see there. But it's a nasty, that's a nasty red mark there on Lowe's. And, we've seen other companies this quarter, just with this type of earnings. FedEx is one, and we talked about it. And I know FedEx, they gapped down on earnings and then rallied, with the market. But it was an ugly earnings report, an absolute terrible earnings report. Triple M. Same thing, just horrid. I think you can throw Lowe's into this category of game-changing earnings report for the negative, and a stock that investors for weeks and months to come are going to be looking to get out of and not get into. We saw Home Depot in their earnings call comment on lumber and the price of lumber and the falling prices of lumber. And this could also be weighing on some of the margins, but it's going to affect Lowe's more negatively than it will affect Home Depot. And so, yeah, it's an ugly report no matter how you slice it. Home Depot is definitely the better of the two, when you compare them. And, we talked about this triple M UTX combo trade, right? Where, you short UTX and you buy, or you short triple M and you buy UTX, or you buy Honeywell, right? And that's the trade. That's, you play the weakness. You don't worry about whether Honeywell and triple M are going up or down, because a lot of that's going to be driven by the market. You're just concerned that, hey, triple M lags Honeywell, or Honeywell outperforms triple M. And we've seen that in a big way here over the since the earnings. I think we're going to see something, probably not to this same degree on Honeywell and triple M, but something similar with Home Depot and Lowe's, where, you can buy Home Depot and short Lowe's, and over the course of the next 3 to 6 months, you're going to see Home Depot outperform Lowe's by somewhere 5 to 10%. Sets up for a very nice combo trade there indeed. All right, so that's Home Depot and Lowe's, just kind of, short look at those. Now, also want to go out and take a look at Chevron. Now, I mentioned I like yesterday that I like kind of some of the stuff we're seeing in Chevron's chart, what's kind of shaping up here with it. But before we go and look at it, take a look at some of these year-over-year growth in earnings, right? Pretty volatile, very typical of an energy company. You can't kind of look at these companies in the same way that you look at a Lowe's or a Home Depot. If we come and we tag this on a revenue standpoint, though, you take a look at Chevron, and yeah, it's one, they're in a revenue dip period here, but a period where they're expecting that to be pretty short term. And most energy stocks kind of look like this, have this same component associated here with it. Now, Chevron took a big hit right here as they announced a bid to go and buy Anadarko Petroleum. APC is the ticker symbol. And, why would investors sell it on that? Well, because they think they're overpaying for Anadarko. And, Chevron was willing to pay into the 60s for this company. But something happened. And you can see Anadarko went higher. Well, this company called Oxy, or Occidental Petroleum, came in and said, no, we're going to go buy Anadarko. And Oxy, said we're going to pay more. And, you can see how investors treated that. They basically said, wow, you're way overpaying, right? Well, how did they treat Chevron? Oh, good. You dodged a bullet there, right, from overpaying. Now, investors have not been willing to take Chevron back to Chevron's previous levels. Why? Well, they're a little worried that is Chevron going to go out and overpay for somebody else? That concern starts to come in. But when we look at energy names and where a lot of these stand, there's a really interesting trend that we see. And I'm going to come in. I'm going to change my chart type to performance here, and let's clear all of our indicators here. Let's clear that. We'll clear these here. We'll come down and we'll look Chevron since July, right? The stock hasn't gone anywhere. You're basically collecting the almost 4% dividend, which is pretty good for Chevron there, but no real performance. Now, if we come in and we put the price of other energy companies in here, right? And we'll do the price performance of something like an Exxon. We'll just put it, behind the price there. you can see that over time, Exxon here, the same period of time, is down 4%. So Chevron's outperforming Exxon, right? Okay, it's not a huge differential, but it's a differential. Well, take a look at Chevron versus ConocoPhillips. Chevron's outperforming ConocoPhillips. Take a look at Chevron versus EOG Resources. Chevron's outperforming EOG big time. Take a look at Chevron versus Halliburton. Chevron's outperforming huge. Take a look at Chevron versus a big conglomerate like BP. Well, BP, they're still lagging Chevron, even though it's a lot less. Take a refiner like Valero. Chevron's outperforming Valero. You kind of get the point, right? Here's XLE, here's the energy index, and here's Chevron. Chevron has been a monster outperformer in the energy space during this kind of pretty tumultuous year for energy stocks. Now I'm going to pause right here. I will come back to this, but need to run the challenge algorithm here and see where we are. So let me do that real quick here on my other screen. And really, it just comes down to, while that runs, as I mentioned earlier, Facebook and Honeywell, the only two that I thought had a chance here to trigger and to come in. Right here, I would not be surprised if they're kind of closing triggers more than morning triggers because of the tighter parameter. But let's see. Alrighty, yeah, no signals. No signals here. Honeywell and Facebook. In fact, Facebook, if we were closing, would likely be a signal if the market were closing right here. But being the morning, it's not a signal here just yet. But you can see with Facebook, you can see the 3-7 crossover that's happening. The 3-day moving average has pushed above the 7-day moving average by 2 cents, right? By 2 cents. So very close there. Now I also have, for the challenge, also have J&J on the board right now, not hitting the time stops, not at the price stops, or even really that close there to the price stops. So I'm not making a move on that. It is something where tomorrow morning would have to take it off if the option is red, and obviously the option is red right now. There's just the stock price hasn't moved all that much there, but the option has lost some of that implied volatility to it, which has kind of dampened the option by about 10% itself, and then the rest is about the small little delta change there. So hopefully it gets a little bit of a move in there. Would be nice to see a late day rally, a nice little kick up in the morning, put the option in the green and let us ride that trend that's up and coming. But so far we've just seen the stock pretty much go nowhere here since the signal. And let's face it, that's kind of where the market is, right? Market vibe is neutral. We've seen the market just chopping around these levels, and we haven't seen any real trend emergence come into the market here of late. And my expectation is that when there's no trend emergence in the market or with a lot of stocks, that the challenge grinds. The challenge grinds and has a few pops and a few drops here, but is able to survive those periods, and that when the market starts to trend one way or the other, stocks start to trend, those signals come in, that's where the real growth for the challenge is. So it's about what I would expect it to be given what the market has been, but always would be nice to have more, but we'll see where those signals lie as we go forward here with it. All right. So anyway, that's the challenge. No trade changes or anything there with that. So back to Chevron, and Chevron outperforming everything within the energy space, and outperforming everything within the energy space in a big way. It's not a small outperformance. It's a very large outperformance here. Now, what's going on with it? Well, when you look at investing in energy, there's a lot of uncertainty out there. OPEC, right? Cutting production, Iran and sanctions there, the global economy and China versus the U.S. Is the economy going to go into a recession? There's a lot of question marks. And then you have this trend where drilling is getting cheaper and cheaper here in the U.S., and U.S. production is basically skyrocketing. U.S. oil production by year, let's see if we can get a quick chart here. But let's see, that's 2010. Let's see here. Someone has something pretty fresh and new. Well, here we go. Tools, time. Let's go to the past year. And let's see. Yeah, so this at least kind of gives the sense of what's going on. It probably is missing some of the most recent data. But this is U.S. oil production, right? Over time, 1985, and U.S. went through a period of, just contracting production here in the U.S. But new technology has, and new findings, Permian Basin and some of the other shale findings here, have absolutely changed the landscape here in the U.S. And the U.S. is pumping out more oil now than it ever has. And it's not like, you look and you go, well, the reserves are depleting and this isn't going to be sustainable. No, it's actually getting more sustainable. There's more reserves. They're cheaper to tap into. And the new technology that has been developed, is making it as such. So what does this do? Well, cheaper production means oil production companies are going to outperform. And that's why Chevron's outperforming. Chevron is a producer. Yes, they have refining operations. Yes, they have drilling operations. Yes, they have exploration operations. But they're ultimately a producer. They're pulling it out of the ground and selling it, right? There are other producers out there, but you go and take a look at someone like a Halliburton. Well, they're making money. They're not producing oil. They're making money as people drill for more oil, as they explore for more oil. Well, with some of the technology and some of the finds that are already out there, companies don't have to outlay hundreds of millions of dollars to go find more oil, right? It's there. They're able to just produce. And they're able to produce at costs that have never been seen here in the U.S., right? In terms of just overall production costs. And the overall production cost to be profitable for some of the biggest energy names out there has fallen dramatically. Now, this is hurting some companies that are out there. Noble Energy, NE, it's hurting them. They're down 65% this year. That's a monster cratering in the stock price. They're going to go bankrupt. Why? What's happening? Well, they're deep water. They're expensive drilling. And there's just no point for it. And with oil hovering in the 60s, and it cost them $80 a barrel to pull the stuff out of the ground, you can't really make any money that way. Transocean rig has the same issue. Tough to make money. When their drilling is a lot more expensive, their production is a lot more expensive, being offshore. Yeah, sure, Chevron has some offshore assets. They have a lot of onshore. They have a lot of very cheap production. Bakersfield, California, other areas around the U.S., they have their rigs set up. They're popping it out. They're able to produce it at $11 to $20 a barrel and turn around and sell it for $60. They have those cash cow elements in their business. Sure, they have parts of their business that are losing money, just like some of these others. But when you just look at the cash cow part of it, they have a much more sustainable cow, much more cash coming in here from it. And so they've outperformed. And the chances of them continuing to outperform are very high. They're going to be the best performers if oil kind of stays within this price range, $10 higher or lower. They're going to outperform the rest of energy. If we see oil break 70, 75, now we're talking about a game changer. Yes, it's going to be good for Chevron for oil to break 75, but it's going to push investors into some of the more risky oil assets that are going to go from losing money to gaining money. And so investors will probably see Chevron, while yes, it'll go up, it'll probably lag a lot of the other energy names. But oil within this kind of $55 to $65 area, $60 to $70 area, Chevron most likely is going to outperform. Now, when we talk about outperform versus underperform, we can talk about Home Depot versus Lowe's, right? We can talk about Triple M versus Honeywell, and we can see that. Well, you know what? One of the easiest trades out there from a combo standpoint is Chevron versus XLE. Long Chevron, short XLE. Is Chevron going to outperform the energy sector going forward? Very probable. Do you have to take risk of Chevron going up or down by hedging there with the XLE? No, you don't. Fine. The market falls off and the market collapses and Chevron goes down. Well, great. It's not going to go down on a percentage basis as much as the XLE. And, hey, things go up, things go higher, at least for the first $5 to $10 in oil. Chevron's going to outperform, and then that's kind of where you take a look and say, you know what, I probably have to reverse this trade because the trade, you probably want to be long XLE and short Chevron with oil $10 higher from where it is right now. Okay, can you play Chevron individually without having an XLE hedge or combo trade in there? You can, right? You can just go buy Chevron, but let's take a look at the numbers, right? Here's the price of the stock over the last 10 years, right? Let's just take a look at revenue here, right? Chevron stock price is about the same as it was back here in 2014. The revenues are nowhere close, right? The revenues are nowhere close. This has not been a monster revenue growth story. Well, why? Well, oil prices are cheaper. Right, oil prices are directly cheaper here. What about margins? Profit margins here for them. Well, they're in a good spot, right? 8-9%. That's better than a lot of their competitors. But they're in a good spot. But it's not super cheap. What about dividend yield? Right? When you look at energy names, dividends don't always matter here, but when you look at some of the big ones, yeah, they do. I mean, it's almost a 4% yield right here. That's not super high. That's not kind of this high that we saw when it went up to 6% when oil cratered at the end of 2015. And it's not down here in the low threes like it was when Chevron was near its highs here in 2018. So it's in a pretty fair spot, and gives investors a chance to pull something from it over time without it being at risk of being cut in a big way. But it's not in one of these kind of super high or super low type areas where you tend to see major change here with it. If you come and you look at you just look at their kind of price, the price of the stock to book value here on Chevron. It's trading at 1.4 times book. That's not super cheap. That's not super expensive, right? And whatever fundamental data we pull in, we're going to get that same story. It's not expensive. It's also not super cheap. Here's PE ratio. It's down here at 16. That's not expensive, but it's not dirt cheap either. And that's where Chevron lies. It's not an expensive stock right here. But it's not something that you look at and go, wow, this is really cheap. This is incredibly cheap. And it's why I like that kind of Chevron versus XLE play a little more than just straight out, hey, long-term Chevron, and hey, expect Chevron to go higher. You're probably right. Chevron probably does go higher over time, but it's one where there's always going to be some smaller risk associated there with it. But Chevron outperforming the XLE over a long period of time with oil where it is now, to me, that's the safer bet. To me, that's the kind of the obvious kind of choice here with that. But anyway, that's my thought here on Chevron. Could you throw Exxon into this category? You could, right? Exxon's always been looked at as kind of the lesser between the two, but Exxon has a much higher dividend. This is one where you look and you go, okay, the dividend yield here on Exxon is pretty massive compared to the rest of the sector. But it's only 0.4% higher than Chevron. Okay. Look at the revenues, right? They have the same thing as Chevron, but it's cratered by a lot more, right? The revenue percentage difference here is a lot bigger than it was with Chevron. So there's a reason that that it's cheaper. The profit margins, they're lower than they've been. The operating margins, same thing. Where Chevron has a lot more stability in that area. So Chevron, no matter how you slice it, is a more stable, better fundamental company. Exxon is going to have a little more risk associated to it, but Exxon will also have a little more reward associated to it on a big move higher in the price of oil. Okay. So anyway, that's a look at Lowe's, Home Depot, Chevron, Exxon here. Hopefully that helps you out as far as those go. If you're just looking at something like a Chevron for a short-term trade, right? To just get in and say, hey, I want to buy it right here, right now. You have some interesting action yesterday. Sold off a little into the close. I was a little concerned with it. We didn't see volume on it at all. And normally when you see a breakout from a consolidation like this, you get some volume in it. There was no volume in it, to suggest, hey, this is ready to hold. There's definitely going to be some resistance in this area. We've seen that come into play. So it's not something where kind of this ultra short-term play, comes into play where you say, hey, you know what, this is going to 130, but buying it at 120 if it dips down there, I think makes some sense, for some of that level. But just short-term charts, you still kind of have this consolidation element that's still prevalent here with the stock, and something the stock hasn't broken out of here, here just yet. Thanks for hopping on. Have yourselves a great day, and we'll talk to you later. Take care.